Switzerland did it. Inflation is down, prices are falling. While the world battles price hikes and debt, the Swiss just made deflation sound elegant.
But don't celebrate too fast, because what looks like a success story
Might be a global warning. In June 2025, the Swiss National Bank cut its interest rate to 0%, marking its sixth rate cut in just over a year. Inflation? Now negative. The last reading came in at minus 0.1%. For Swiss households, that means groceries are cheaper, but wages may stagnate. For the rest of the world, it's a warning. While most countries are still trying to tame inflation, Switzerland has officially entered deflation. Let's break down what's really happening and why it matters far beyond the Alps. Let's start with the basics. Switzerland isn't like most economies. It's small, export-driven, and deeply integrated into global trade. It also has one of the strongest currencies on earth, the Swiss franc, which rose by 11% against the US dollar in 2025 alone. That's great for importers. Everything from fuel to smartphones is cheaper, but it's a disaster for exporters. And for inflation. Imported goods get cheaper, domestic prices fall, and inflation, which averaged 0.6% earlier this year, finally flipped negative in May 2025. The Swiss National Bank's response? A rapid series of cuts, bringing the key rate down to 0% by mid-June. This isn't normal. Switzerland hasn't seen a rate this low since the post-2008 era. And even then, they hovered just below zero for years to avoid a strong franc. So why now? Because the SNB is trying to do something it rarely does, get ahead of a global downturn. And if Switzerland is worried enough to cut this fast, other central banks should be paying attention. At first glance, falling prices sound like a consumer dream. But in economics, deflation is dangerous. And here's why. Consumers delay purchases, waiting for prices to fall further. Wages stagnate, but debt doesn't shrink. Investment dries up as returns shrink. Exports collapse, especially with a strong currency. Switzerland is now seeing exactly this pattern. Despite strong balance sheets and stable institutions, the country's economic growth has slowed to just 1.4% in 2025, one of the weakest rates in Europe outside recession-hit zones. Meanwhile, the SNB is boxed in. It doesn't want to return to negative interest rates, but it also can't allow the franc to strengthen further. And inflation is now projected at just 0.2% for the entire year. So the SNB is doing what central banks hate most, fighting to increase inflation. And if this deflation deepens, it could spill into neighboring economies, or worse, become a blueprint for post-inflation stagnation across the West. Let's talk about the Swiss franc, often called the world's ultimate safe haven currency. When the world is uncertain, war, tariffs, recession fears, money flows into the franc. And that's exactly what happened in 2025. With rising instability in the Middle East and persistent trade tension between China and the West, capital flooded into Switzerland. That pushed the franc up more than 11% this year alone. But here's the problem. That kind of currency strength crushes competitiveness. Swiss exports, watches, pharmaceuticals, precision machinery, are now more expensive abroad. Tourists from the Eurozone, fewer of them can afford to visit. Even domestic producers are getting undercut by cheaper imports from Germany and Italy. This creates a loop. Strong franc equals lower prices. Lower prices equals deflation. Deflation, wird rate cuts. Rate cuts equals more capital inflows. Repeat. And unless the SNB intervenes directly in currency markets, something it has avoided so far, that loop could tighten. This isn't just a Swiss problem, it's a preview of what happens when confidence becomes distortion. Switzerland's economy is small, but its signals are loud. When Switzerland cuts early, it often foreshadows a broader European pivot. Back in the 2010s, Swiss monetary moves were a lead indicator for what came later in the Eurozone. The same may be happening now. Why? Because the economic symptoms are spreading. France has near zero growth and falling factory output. Germany is flirting with recession, again. Italy is experiencing price stagnation despite wage hikes. And across the EU, consumer demand is softening. If Switzerland is slipping into deflation, how long before the ECB follows suit? The ECB was still holding rates steady in early 2025. But if inflation across the bloc continues to slow, it may be forced to follow the SNB's lead and pivot fast. And that would shift the entire global rate landscape. Because once Europe cuts, the pressure is on for the Bank of England, the Federal Reserve, and the Bank of Japan to respond. Let's zoom out. In a world still obsessed with fighting inflation, Switzerland just reminded us of the other danger. What if growth dies quietly, without anyone noticing? While much of the world is managing price spikes, Switzerland is already managing the aftermath. This could be a preview of 2026, where the inflation narrative fades, but new risks emerge: stagnation, currency imbalances, debt strain under slow growth conditions. It's also a reminder that interest rates can't stay high forever, because even small economies, when forced to cut, start a global chain reaction. And for investors, this changes everything. From bond markets to gold to Swiss equities, the safe haven narrative is now less about safety and more about survival. For everyday people, it means being wary of good news that feels too good, because falling prices don't always mean progress. Sometimes they mean the world's run out of momentum. Switzerland beat inflation, but in doing so, it may have revealed something worse: economic silence, the moment after the noise. The SNB's race to zero isn't just a national policy shift, it's a signal to the world that the cycle is turning again. So next time you see a country celebrating falling prices, ask this: what's the cost of calm? And who pays it? This is 360 Economy. Subscribe for more global breakdowns in under 6 minutes. Because today's economic battles aren't just about crises, they're about what comes next.